Final trade time, Tim.
I talked about Rio Tinto valuation call, div call, Rio.
Courtney.
Also in copper, FCX, I think it's worth taking a look. It's down about 10% over the last 6 months, even though copper prices are up.
Coppery tonight.
Nice.
Steve.
Another metal for you, steel. Letter X, I think it has a little more gas in the tank to go higher.
We got Georgetown University. Make noise so the people know you're here.
Wow, they are here.
Bristol Myers, that'll get you done.
All right. Thanks for watching Fast. See you back here tomorrow at 5 for more Fast Money. Mad Money with Jim Cramer starts right now. Wave, Georgetown.
Cramer, welcome to Mad Money. Welcome to Cramerica. Other people make friends. Hey, man, I'm just trying to make a little money here. My job is not just to entertain, but to explain, to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. You can be cynical and corrosive, or you can be critical and constructive. In real life, I know many smart people who choose the former, including even when it comes to stocks. My view, you can be as cynical and corrosive as you want about the vast majority of things in the world, in life. But if you're trying to make big money in the stock market, you're actually better off being critical and constructive. Reflexive negativity is not a smart strategy, and you will most likely trade yourself into oblivion with very little to show for it. Now, if you don't adopt that more constructive approach, then on days like today, Dow gained 272 points, S&P advanced 0.41%, NASDAQ declined 0.18%. You're going to miss some terrific opportunities, the ones that abound daily around here in the greatest market in the world. Let me give you a few very obvious and gettable examples for you of stocks that have soared in the last week, stocks that were previously written off, and many of them were left for dead. The cynics missed all of these moves. The optimists, with the exception of one, you could have caught all of them. I want to start with today's trading. This morning, Walmart, largest retailer in the world, reported, and the stock initially rallied on the strength of their results. That was about 7:15 in the morning. But then management was cautionary about tariffs, don't blame them, and the need to raise prices on the conference call, don't blame them, and the stock very quickly reversed and dropped 6 points from its peak before the market opened. Now, I have to tell you that reaction staggered me. I was on television, and I pointed out that Walmart's kind of like the Philadelphia Eagles. The Birds won the Super Bowl because of their dominance in what we call the trenches. I'm positive that Walmart, too, will be a winner because of its dominance in the trenches, its expertise, its sourcing, its inventory management. Those are second to none. I mentioned that their balance sheet gives them a level of flexibility that the other retailers most certainly don't have, with the exception of Costco. Walmart can be tough with suppliers because they've got more bargaining power than any other store on earth because they've got that scale. And let's not forget that a quarter of their profits come from advertising, amazing gross margins there, and membership income. That's an unassailable set of qualities equaled only by Cramer Fave Costco. These advantages aren't going away because of the tariffs. If anything, I think they're going to be accentuated. Tariffs are a problem for the entire industry, but Walmart's one of the rare companies that can cope. Sure enough, the stock rallied from down 3 and change and almost back to even. And I think the cynics who don't believe that Walmart can handle this moment, they are destined to be losers. Now let's talk CoreWeave, the one that was probably the hardest to get. It's a company that runs data centers that are geared toward artificial intelligence. This company came public at the end of March at $40. It was almost like a forced IPO. They had to get it done. Before the IPO, everyone thought this was a red-hot story. But then Wall Street gave up on the entire AI edifice, and people lost interest in this deal. It had to be downsized. And by the way, it also come at a much lower price because people were so skeptical of its business model. CoreWeave's the classic example of what I'm talking about. We took a hard look at it right here, met with the principals, even visited one of their data centers when we were out in Las Vegas. And we were convinced that these guys are real pros, the real deal, so to speak, and that the business really is en fuego. I knew people would be nervous about this one because as a young, incredibly leveraged company, it could stay unprofitable for some time. But as people got more comfortable with it, they realized that CoreWeave was actually doing incredibly well, something that the people at NVIDIA confirmed. NVIDIA is a big investor in CoreWeave, and it seems like the relationship was very strong. Sure enough, this stock got crushed, dropping from $40 where it came, the price that of where it came public, but that's where they priced the deal, to $33 in 3 weeks. But you know what? We kept pounding the table, knowing the CoreWeave business was doing great the whole time. A few weeks ago, the stock bottomed, and by last night, it had roared to $67. When the company reported last night, everything I said would happen happened. And the stock initially rallied hard in after-hours trading, although eventually it pulled back because management plans to invest heavily to meet sky-high levels of demand, and people are freaked out by that. Still, the stock's basically doubled since late April when I told you had to buy it. People were just too cynical and uninformed about the prowess of the scrappy company, and it gave the constructive and optimistic among us a much better opportunity to buy than anyone thought possible as recently as a month before the IPO. More on CoreWeave later in the show because it's such an important situation. Next, okay, how about let's go back to the obvious. Boeing. See, for the longest time, Boeing stock was a pariah because it seemed like they'd forgotten how to make airplanes. Now, we know a couple of things about Boeing. First, it's one of the only two major aircraft manufacturers in the whole world, the other being Airbus. Second, it had a hideous balance sheet. I mean, just awful. I mean, just
the house of pain.
Thanks to all the accidents in recent years. As long as it was hobbled by a bad balance sheet, the stock was too dangerous to own, and you were right to be critical. But in October of last year, Boeing used the capital markets as they are intended, tapping investors for $24.3 billion in stock and bonds. They sold 112.5 million shares at $143. That was enough to put the balance sheet, let's say, on even keel, so that the company could start playing offense. Now, Boeing just won the biggest order, 150 jets it's had. It's a deal that President helped broker when he was in the Gulf. Every country we trade with wants to extend an olive branch to the White House, and the easiest way to do that is by placing gigantic orders with Boeing. Now the stock's at 206. The stock rallied more than $60 from its lows last fall.
House of pleasure.
You just needed to be sure the balance sheet was fixed, and suddenly the loser became a winner, much to the cynics' dismay. Look, these things occur every day around here. Think about what happened to the stock of Disney in the last few months. A week ago, the stock was at $82. A month ago it was at $82. 1 month. People were buzzing about how the theme parks are too expensive, the sports entertainment's too expensive, the movies are either too woke or not woke enough, depending on who you ask. You never heard anyone say it got the right amount. Now, 1 month later, Disney's at $112, pretty much in a straight line. The company reported a terrific quarter. Turns out people are willing to pay top dollar for the theme parks. The sports deals are making plenty of money, and I guess the movies, well, let's say they hit the Goldilocks level. Not too much, not too little. Same company. Just written off by the pessimists, the ones who gave up on all of that excellent expertise and intellectual property. Think of the money that they didn't make. Or let's not forget the best of them all, which is NVIDIA. Not long ago, people decided that despite ample evidence to the contrary, the big AI data center thesis was just over, kaput. The Chinese have supposedly come up with a better mousetrap. Remember that DeepSeek issue? The Biden administration put up barriers that prevented NVIDIA from selling chips to most countries. Unbelievable. Adding insult to injury, the Trump administration put through rules that caused NVIDIA to take a $5.5 billion charge for chips it could no longer sell to China. At that moment, it was easy to believe that NVIDIA's Cinderella run was just a fairy tale. But this story was always reality. Not only did the demand never go away, but now the president's helping these guys land huge orders from the Gulf monarchies. That's how a stock runs from 94 to 134 and change in 5 weeks. And I think it could go even higher now that Jensen Huang, the CEO, is about to go to Taiwan to spread the GPU gospel next week. I'm expecting some big orders over there. Look, the market's full of stories that sound too good to be true, but they are true. The terrific run in ATT that you've called me about. The amazing comeback of First Solar that so many people are interested in. The resurgence of a strong ad tier in Netflix. But they're the real deal. So here's the bottom line. If you examine these same opportunities with a jaundiced eye, too critical, too negative, I know what would have happened. You would have passed on all of them. But if you were open-minded, if you were constructive, any one of these could easily have made you a boatload of money. I want to go to Ryan in Ohio. Ryan.
Hey, Jim, how are you?
I am good, Ryan. How about you?
Good, thanks. Last time I called, I inquired about a new book by you, and you couldn't comment, so I'm glad to say that I finally have an answer to that.
Well, it's coming. It's coming. I don't like to promote things before you can get them. I mean, this is actually something they gave me to promote, but in reality, it's something of no interest to me inside it. But because it's not my book. You see, because it's not finished yet. But thank you very much. How can I help?
So the reason why I'm calling, I'm inquiring about a stock that currently has a PE of 59, and looking at the daily chart, it looks like it wants to form a massive head and shoulders pattern, and recently it partnered with a firm which may give some insight into the state of the consumer. So my question is, more so in the short term, what do you think of the stock, not the company, of Costco?
Of Costco? Costco's fabulous. I mean, I think Costco may be, just I saw that Affirm deal. I was surprised. Costco's so good that the stock went up $18 on Walmart's problems. Now, that is wrong. First, Walmart doesn't have any problems. But second, Costco has a better business model because they get all their money from the card. But when I saw that, I said, wow, people are finally starting to get rewarded. They get why I think Costco is so fantastic. Let's go to Nick in Florida, please. Nick.
Hi, Jim. Booyah.
Booyah.
How are you today?
Today was a weird day. I was hungry all day. Kept sending people out to get stuff to eat. I don't know why. I can't even tell you why, but it was a great day because, boy, they brought back great stuff. How can I help you?
Awesome. So DraftKings lowered their full-year revenue for 2025 due to favorable sports outcomes in the first quarter.
Right.
While still projecting year-to-year growth around 32%, DraftKings CEO noted a slight slowdown in April and attributed to sports seasonality.
I know.
Do you still think DraftKings is good, or
Nick? I've got to tell you, you could say I've been too bullish on it. I just really believe that we're still too far away from football season, but I do genuinely believe that what has to happen is some of these states that don't have gambling have to get gambling, and that's what I think it's really about. I thought it was about the handle. I thought it was about the hold. I'm beginning to think it's about these states that don't allow gambling yet that have to. Right, now listen to me. Any of the stocks I just mentioned could have made you a boatload of money, but you had to be open-minded and you had to be less corrosive and more constructive. Remember that word, constructive. Oh, man, money tonight. Could there be a new fuel ahead for natural gas? I don't know. I'm going to dig into the state of oil and gas company with the CEO of a club named Cotera Energy. Then CoreWeave, I just mentioned they reported their first quarter. I got to give you really a bigger deep dive because it's so important right now for the stock market. And later, I'm checking in with a standout stock during Mad Money's tenure that I used to own as a hedge fund manager called UFP Technologies. Don't miss my conversation with the CEO and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Earlier this week, I told you we could be looking at a natural gas renaissance in this country, even as I'm a little less confident about oil. And that's why we own Cotera for the Chapel Trust. This Houston-based oil and gas producer is more slanted to gas than oil, and they have the flexibility to shift production, whichever fuel is doing better. Sure, when the company reported a week and a half ago, the quarter wasn't perfect, thanks to some operational issues in the Permian Basin that we will get into. But Cotera is doubling down on their natural gas assets, which is what we want to hear. The stock sold up 9%, though, in response to that quarter. Since then, it's erased most of those losses. Can it keep running? Let's dig deeper with Tom Jordan. He's the chairman, president, and CEO of Cotera Energy. To learn more, Mr. Jordan, welcome back to Mad Money.
Thank you, Jim. Pleasure to be here.
Okay, so Tom, this is really when the model works. We see a big disparity. We know that the president seems to be hell-bent on trying to get oil down, but because of the strong demand worldwide for natural gas, that's going higher. So is this the time when you feel that it's going to prove out the model?
Well, I think it has, Jim. We announced in our release that we're increasing some activity in our gas assets. We have tremendous low cost of supply in our Marcellus shale, but also our Anadarko, and we are ready to roll. We produce 3 BCF a day, and we have terrific exposure to the upside natural gas.
So we are close to what's going on in the Gulf, and it looks like there's going to be more and more export there. I think people start to understand that it's possible that Cotera, even though it's all the way up in the Marcellus, can still produce and get that natural gas down to where it has to be to ship.
Yeah, we can. We do have, as you know, some LNG contracts, and they're creatively structured so we can take them from several of our plays. But, we're not advantaged in the Marcellus for LNG just because of the distance. But look, increased demand for natural gas buoys everybody. So, whether it's electricity demand, LNG exports, bring it on. We're going to have great exposure to that upside.
Okay, so we had Toby Rice on. I know you know him, EQT. He was talking about a belt that I didn't even know about, the Carnegie Mellon area, the data center belt. And I know that you guys have some business there. What's your take on the data center and how much more they need?
Yeah, they look, whether the forecasts are reasonable or overdone, they still have a lot of room to be overdone and still be excellent. I think there's a broad understanding that natural gas is the only alternative for a reliable, low-cost, dispatchable power supply. It also, to the extent that it competes with other fuels like coal, it lowers our emissions footprint. It's ready to go, and data centers are craving it. That whole Pittsburgh area with Carnegie Mellon is a wonderful technology center, and we think there's going to be several of those around the country. And the nice thing is we've got broad exposure to West Texas, to the Anadarko, to the Northeast. So Cotera is really well positioned for this.
I just got back from Europe last week, and I've got to tell you, everyone was talking about Spain and the problem with Spain just going dark, and a realization that there was maybe a little overzealousness in getting rid of fossil fuels. Are you hearing people saying, you know what, we've got to be really careful here. We don't want to get to where Spain is. We got to be absolutely ready with natural gas turbines the second something happens?
Well, that's exactly right, Jim. We're not against any energy source. I mean, whether it's solar, wind, nuclear, natural gas, hydro, coal. I mean, they all have a role in the energy mix. But the problem with renewables is they're weather dependent, and that weather can be broad among regions. And so when the sun's not shining, the wind's not blowing, you have a deficit of energy. And if you build a grid that relies on that, and you don't have that alternative that you can mobilize immediately, that being natural gas is certainly one of those, it's just bad energy policy. I mean, it's just constructed to fail. And energy sources need to handle peak demand, not average demand.
Right.
And they've designed a system built to fail, and it did.
All right. Well, now let's just go to oil. For as long as we've known each other and talked to each other, my Chapel Trust has owned you, you've been unbelievably good, and everyone's entitled to a miss at one part of their portfolio. Yeah. People were on the conference call very worried about the Harkey area. It's one of the areas that you have that in Culbertson County, and I want to be sure of this rather than just rehash what happened. How do you feel about your oil assets, and whether it's just you had a temporary blip and you're just on, or you are deeply concerned and you're trying to figure out what the heck went wrong?
Yeah, we're really bullish on our oil assets, Jim. This was an operational issue, and our bias, as you know, is to be transparent, describe it as fulsomely as we can, not attempt to gloss over. But it's a situation that's fixable. We have the fix identified. We've tested it. It appears to be working. But, we did take those volumes out of our remaining year guide just out of abundance of caution. They're going to work their way back in, and people are going to realize that they overreacted. And Jim, if you'll allow me, we reported a great first quarter. It was our expectations for the second quarter that people were reacting to. But we also lowered capital for the year and reaffirmed our annual guide. Our annual guide is unchanged. So this is a very short-term issue that we're fixing. And I think people that globalize it to our assets are just really, one, not understanding the issue, and two, overreacting.
Very good. That's all I need to know about that. Now, let's talk about the acquisitions you made. How are you feeling about it? I know you want to pay down the debt, which I want you to do, because that's more prudent than anything. But are they working out so far?
So far, they're working out tremendously well. In fact, Jim, I'll share with you, I spent almost 3 hours this morning with the technical team going over blow-by-blow geologic detail of what we've learned about that area, and we couldn't be more excited about it. It's a challenging area. It involves very detailed geology, But we understand it as well as anybody. And I came away from that meeting walking on air. I'm so glad that we made that acquisition.
Excellent. Now, why do people keep talking about this magical 50 number? I don't know why people dream stuff. You've taught me not to say, oh, it's going to be at 50. You don't do that stuff. Why is everyone so certain that oil's got to go down?
Well, Jim, the truth of the matter is the world is oversupplied.
Okay.
If everybody just opened the spigots, it's oversupplied. And we've seen discipline out of OPEC because it's not in their interest to produce, and they have social costs. So they have interests that want them to restrict their maximum production capacity. But, we're watching this situation. We announced we were laying down a little activity. Not so much because we can't make a living at this. At $55 oil, our returns are really good. But we want to watch what happens with the tariffs and will that impact our cost structure. We also want to see if costs will go up or down. Typically in a down cycle of price, your costs decrease. But with these tariffs, who knows what's going to happen. So we thought it was just, we could lay a little activity down, not interrupt our total year guide, and we thought that was the prudent move. So we're watching this situation carefully. We're hopeful it'll be resolved, but there's a lot of pieces that have to come together here.
Well, to me, I'm just glad you have the optionality, which is why we chose yours to own of every oil and gas company, because I want someone who knows how to switch and knows what to do, because there's one of those two can really go really high, and the other one, as you said, it's oversupplied right now. Anyway, Tom, I'm glad you answered the tough question about Harkey, but what I care more about is how well is natural gas and how those acquisitions are doing, because that's what's going to determine things, not that one well with some water in it. On our side,
yeah, Jim, you made a smart choice. Because, as we showed in our deck, we can run $50 oil and as low as $275 gas in various combinations, and our cash flow is remarkably resilient through that changing landscape.
Absolutely.
So we're built for this.
I think you definitely are, and I feel good about it. Tom Jordan's Chairman, President, CEO of Cotera. Tom, thanks for coming on.
Thanks so much, Jim.
Okay, Mad Money's back after the break.
Coming up, can AI push CoreWeave higher? Cramer's digging into the company's latest earnings report, seeing if now is the time to get in on this data center player. Next.
No stock tells the story of this market better than CoreWeave, the AI data center play that I mentioned at the top of the show, the one that just barely managed to come public at the end of March. For those of you who don't remember, CoreWeave basically builds data centers using NVIDIA's hardware. NVIDIA's a big shareholder, by the way, then rents out AI-level computing power to its customers, including some of the largest players in tech like OpenAI. Unfortunately, by the time this one came public at the end of March, the AI infrastructure story had been in the doghouse for a couple of months, and people were starting to worry about whether the president's trade policy was going to hurt this business, too. They had to cut down the size of the deal dramatically and also slash the offering price just to make the darn thing happen. Boy, it came close to failing. Well, CoreWeave saw a nice pop a couple days after its IPO, climbing quickly up to the $60 by April 2nd. That led directly into the Liberation Day tariff announcement that sent the entire market into a tailspin. Over the course of the next few weeks, the stock plunged as low as $33 and change. That's $7 below where its IPO was priced. But that's when the market started to regain confidence in the AI infrastructure theme, largely because when the hyperscalers, those big companies we talk about all the time, reported, they kept reaffirming their plans to spend tens of billions of dollars on new data centers. So as we got these earnings reports and the White House backed away from the most punitive tariffs, the whole AI complex came roaring back. And that's how CoreWeave stock managed to double in less than a month, closing at $67 and change yesterday as we awaited the company's first earnings report since its IPO. Now, I have been very bullish on CoreWeave, probably the most bullish of anybody I talked to, but even I was feeling just a little worried about the setup. You never want your stock to run too much into the quarter because then there may be too much froth into it. So what did we learn last night? Well, first of all, there wasn't a lot of froth because CoreWeave blew away Wall Street's revenue estimates, $420 20% sales growth year over year. That's astonishing. Management also said they had a revenue backlog of $25.9 billion at the end of the quarter, consisting of remaining performance obligation of $14.7 billion, as well as $11.2 billion in estimated revenue from contracts that are, quote, subject to the satisfaction of delivery and availability of service requirements. I mean, they're not in the bag yet, but it's pretty assured. The analysts are only expecting these guys to do $11 billion in revenue next year, but the remaining performance obligation already covers that and then some. And that's even if you assume that's how somehow they just stopped doing business. As for profitability, CoreWeave's margins were slightly below expectations, but thanks to the magnitude of the revenue beat, their adjusted operating income still came in nicely better than expected. In other words, if you were in on that IPO, you did darn well. In a nutshell, CoreWeave had much better than expected sales, but the profitability lines were a little mixed. Initially, that was enough to send the stock higher in after-hours trading. It got as high as $75 last night, at which point the stock was up more than 11% from Wednesday's close. But that was only the first move in what was a wild after-hour session, followed by some more crazy gyrations today. See, the stock reversed not long after CoreWeave's conference call began at 5 p.m. Last night. The main theme on the call was that demand remains incredibly strong, with CFO Nitin Agrawal saying, quote, while we acknowledge the general global trade and macro uncertainty and volatility, we haven't observed any impact on customer behavior. In fact, we are seeing an acceleration of customer demand, end quote. That's what I'm always looking for, right there. But the flip side is that CoreWeave also was seeing elevated costs for certain essential pieces of equipment, something they described as an industry-wide issue. In order to address their incredibly strong demand, the company's planning to spend a lot more money growing the business this year. Fact of life. Speaking of investments, CoreWeave made an acquisition in the first quarter, acquired a company called Weights and Biases that offers a platform for AI developers, which will essentially serve as an on-ramp for CoreWeave's infrastructure for new AI startups. I think it's a very smart move. It makes the company even more proprietary than it is now. Some people worry that it's a commodity business. It's anything but. But all of these factors, some elevated costs, ramping investments to meet strong demand, and that acquisition explain why the company's margins were not so hot in both the quarter they just reported, and by the way, also for the guidance for the full year. Overall, the second quarter guidance was directionally similar to the first quarter results. Very strong top-line results thanks to excellent demand, but with worse-than-expected margins thanks to higher costs and elevated investment. And we basically saw the same thing in the full-year forecast. Now, there's one more key element here. CoreWeave says it will shell $20 to $23 billion in capital expenditures this year as they invest heavily to meet sky-high levels of demand. Now, that was significantly higher than the $18.35 billion number that the analysts were looking for, and it probably freaked out some investors because the company will have to borrow billions to pay for it. But again, all of these numbers tell basically the same story. Excellent demand and a major investment cycle from the company to meet that demand, even if the company has to make some near-term compromises on profit margins to grow its capacity quickly. They are right to spend. This is a land grab. They are the superior operator. So why not try to get as much business as you can? It will be worth it. This morning, I spoke to CoreWeave CEO Michael Intrator on Squawk on the Street, and he explained the company's doing this because their biggest customers are desperate to get more computing power as soon as possible. They're not banking on prospective future business either. They only go out and build additional infrastructure after the contracts are already signed. The payback's assured here. Listen, I know this is not the simplest story to get your head around, especially because it looks like they have so much debt and don't have a lot of cash. And that's not the case. But that is why the stock's such a wild trader, frankly. Ultimately finishing down over 2% today, despite being up as much as 8% and setting a new high earlier in the day. Maybe too wild for all of you, so you got to think about it if you want to buy this. Ultimately, once you get past all the talk of revenue growth, backlogs, margins, CapEx, I think the CoreWeave story comes down to whether or not you trust management, specifically whether or not you trust that the investments the company's making today will pay off down the line. Given that they've already got lots of new business lined up, I do trust them. So far, that's been a real good call, and I have to tell you, I was one of the few that was not but like I said at the top of the show, I was constructive from day one. Stock's been a big winner for anyone who had the guts to buy it near its April lows, or of course was even on the IPO. Here's the bottom line. As far as I'm concerned, this was a great quarter from CoreWeave. The demand for the computing power is clearly there, and that was not a given at the time of the IPO, when everyone assumed the AI infrastructure story was about to collapse. Yes, there's some hair on this one, as the company is now spending aggressively to take advantage of this opportunity, something that's clearly, well, it's got some risk to it. But there's so much demand, I think they'd be crazy to do anything else. Let's talk to Sam in Pennsylvania. Sam, how you been?
Jim, how are you?
I'm doing well, thank you. What's happening?
So, Jim, after listening to both Meta and Google's Q1 earnings call, I was struck by the bullishness that both companies had regarding advertising. So given the uncertainty around Google, particularly the potential competition with AI with the search business, I was looking for a way to invest in this growing, booming advertising market, and I came across Trade Desk. And the stock looked like a real buy, so I picked some up before earnings. Seems to be headed higher. Revenue is growing. Everything seems to be good. I'm curious what you think about the Trade Desk as a way to kind of a double click before Google bought it. Kind of a interesting way to play the ad market.
Sam, you made the right move. Now, let me tell you something. They had a self-inflicted issue. In other words, they had a problem. They made a mistake. They had it was like they were doing new software and it didn't work initially, and the stock just got crushed. It went all the way down from like 120 down to 60. But I will tell you, it actually went down to 42 at one point in April. That I think all the problems are fixed, and all the things you said that are good, they're happening. I like your call. I think you're right. I would actually buy more. All right, the way I see it, this was a great quarter from CoreWeave, and I know some people are confused about it, but you've got to understand the concerns about margins and spending, I think, are, while they're correct to be focused on, they are not wrong. The company should be spending. They've got a great opportunity. All right, much more Mad Money. I include my associate with MedTech player UFP Technologies, which I had a 20% position of when I was a hedge fund manager, but that was 35 years ago. I had a lot of hair. That didn't come up when we talked with the company. Then I'm recapping how Oval Office occupants have shaped the global AI landscape and where semi-stocks like NVIDIA stand as a result. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. A few weeks ago, as part of our 20th anniversary show, I went over the 20 best performing stocks since Mad Money first went on the air. Now, most of these are now household names, but there was one small company on the list that I hadn't been following for a long time, and that's a company called UFP Technologies. It's a $1.9 billion company that's an outsourced designer and manufacturer for medical devices, sterile packaging, and other highly engineered custom products. Niche, but it's a great niche, becoming an important link in the medical device supply chain, and that's one of the reasons why the stock's up nearly 100% since the show first premiered in March of 2025. I can't believe it's been that long. Wow, we've been on a long time. And hey, it still has some juice here. UFP's up a quick 16% since I mentioned it again at the end of April after a company reported a strong quarter last Tuesday. Now, when I mentioned this one on the anniversary show, I extended an open invitation. I'm glad they say they accepted it. So let's check in now with Jeff Bailey. He's the chairman and CEO of UFP Technologies to learn more about his company and how the heck they've done so well. Mr. Bailey, welcome to Mad Money.
Thank you, Jim. Thanks for having me on the show, and congratulations on your 20 years. That's a big deal.
Well, congratulations on your success, because I met you about 30 years ago. Your company was a huge position of mine for my old hedge fund, and that was because you were well ahead of your time in terms of packaging. At that point was how you got your Hewlett-Packard. So tell us how you went from being that kind of really good environmental packaging that was not wasteful to being something that's really about the highest end packaging you could possibly have.
Yeah, so our strategy is very simple, and it was basically born out of scar tissue. We were always an innovative company that would solve problems but couldn't always keep it. Some of the examples that you knew way back when. So we started asking ourselves, who really values our really close precision tolerances? Who values our knowledge of materials? And we had been in the medical space already for quite a while. In about 2018, we made a concerted decision to focus and really become a med tech company, and so bring up all our standards. And so now our goal is to help our customers innovate, and then to help them take costs out and take risks out of their supply chain.
Now you have 26 of the top 30 largest medical device manufacturers, robotic surgery, orthopedic, sterile packaging. What happens? They all find out that you do it, or you're constantly saying, listen, we can do it better than the guys, knocking on doors?
So we were pioneers in robotic surgery 20 years ago. We got started in this. And so we finally, again, learned to add more value to our customers. We bought the next step in the value chain, and we became a better mousetrap. And so basically now we deal with like 20 different robotic surgery companies. So all the major players we're working with now.
Okay, so you're doing infection prevention and wound care, therapeutics, surfaces and support. Now, how do you have this breadth of knowledge about all these things and doing robotic surgery?
So what we have is a lot of knowledge about specific processes and about specific materials, and those solutions apply to all these different cases. So, for instance, in infection prevention, we're doing a lot now with external catheters. It's a new innovation. And so it matches perfectly with our skills and our materials knowledge.
Okay, well, let me ask you, on the conference call, you guys have been terrific at robotic surgery end market. Multiple years of growing 20%. Plus, but the end market declined 6% in the first quarter. You told us, kind of, don't worry about it, so to speak. But that was a big delta. Is everything all right?
The advanced components decline? Yeah, so beginning of last year, the military was doing a get readiness for war thing, partly out of the Ukraine thing. They placed an enormous order at the beginning of 2024. So it's really a comp. So we actually expect by the end of the year, advanced components will be growing. It's a low single-digit grower. It's not a ferocious growth rate, but it'll be back in.
That's what. Okay, good. Because the company's been doing so well, and the stock went up after we talked. I want to be sure that everything is definitely on target. Now, you've been around for 60 years as a specialty packaging company, and I was trying to figure out what happened to the stuff that I saw when you used to do specialty packaging for computer companies.
Yeah, so we've pivoted a number of times, always trying to find where we can add the most value, those segments that valued us. So packaging became more commodity, we became into molded medical packaging.
Right.
Introduced us to customers, and then we more and more markets, more and more value add. And sort of our strategy evolved on this market to sweet spot concept.
Okay, so how did you get into, I have to ask you to describe robotic drapes?
So 20 years ago, our biggest customer showed up in our conference room trying to make the critical component that separates the robot from the surgical instrument. It was a precision molded part. We were experts in molding, and right. So we were the right one to come to. And so we were doing this part for 15 years, and we decided to try to do more and more and more for them.
Okay, needleless injection port cleaner. You've got to be the only one in that business.
Well, the infection prevention also maps to our skills. So these guys who want unique materials that can do special things come and find us, and we show them materials. We help them develop their product. Then we often build custom equipment to make it, and then we make the product for them.
And you make them in the United States.
We do, yep, those, yep.
And there's no problem, right? There's plenty of...
Well, we have, I'd say, 2/3 of our revenue in the U.S., but we have factories outside the U.S. We've followed some of our customers who asked us, but most of our business is in the U.S. And yes, that particular product's made in Texas. No problem.
No tariff problems?
No problem.
Well, I've got to tell you have a really interesting niche business, certainly much more high value added than when I first met. I mean, I can't believe I'm sitting opposite someone who we had about a 4% position in your company, because we thought that you were the first to recognize the greatness of trying to do the right thing in packaging. And a lot of people get angry at packaging. Even when I went out to Amazon, I told Andy Jassy, why can't you do better packaging? Everybody wants the best packaging. And that's really your niche, isn't it?
It was once upon a time, and we've
But now it's medkit.
Exactly. Yeah.
Well, it's a great compounding growth. You certainly deserve all the success you had. And I hope people understand that this is a company that has morphed into doing something that's the most high value added from when I met you, which was you were just very environmental, which I love. That's Jeff Bailey, Chairman and CEO of UFP Technologies. Jeff, thanks for coming on the show.
Jim, thank you.
Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Chris, remember, for our calls, you say in the stock, I said, buy, sell, another course, stock question, that much difference. But you play this out. And then the lightning round is over. Are you ready? Ski that on the lightning round. I'm going to start with Margaret in New York. Margaret.
Hi, Jim.
Yo, what's happening?
First time caller, long time listener. Would
Excellent.
like to ask you about a semiconductor equipment company that manufactures globally and in the U.S. right in Wilton, Connecticut. It is ASML Holdings.
No, the last couple quarters have been weak, I've got to tell you. And by the way, Applied Materials reported a quarter that some people didn't like tonight. If you want to be in that industry, you have to buy Lam Research. That's the best one. Now we're going to Jonathan in Pennsylvania. Jonathan.
Booyah, Jim. Congratulations on 20 years of madness and money.
Thank you. Oh, I like that. And I'm still going strong here, I hope. I like it. What's happening?
There you go. Jim, Yogi Berra once said there is no difference between practice and theory, but in practice there is. So, in theory, stock splits should not matter, but in practice they often do. I want your opinion. In addition to all the buybacks, do you think the upcoming stock split of O'Reilly Automotive will rev this stock higher?
No, and what you want to do is you want to buy the one that's not going to stock split, which is AutoZone, AZO. Take a look at that chart. Well, you'll see a real nice move. Let's go to Stanley in California. Stanley.
Jim, how are you?
I am good. How are you?
Can I just tell you how much we missed you last week when you were on vacation?
I was on Art Barge in Holland and Belgium. I call them the Low Countries. I made that up. What's happening?
Welcome back. I'm calling about On2 Innovations. I mean, with this pullback, is it a good time to get in?
No. I mean, look, test and measurement is always going to be letter A. That's what I like. I like Agilent. I'm not going to change my mind. I need to go to John in California. John.
Hey, booyah.
Booyah.
Jim, how you doing?
I am doing well. How about you, John?
For you. I'm doing great. Thanks, man. Got one for you. FLR.
No, FLR, engineering construction, we're going to buy letter J. We'll buy Jacobs. Now, I've got to tell you, the best one happens to be private, which is Bechtel. But the next, we'll take J. That'll do it. AECOM's not bad either. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, is it a new era for chip makers? Cramer's breaking down the Trump administration's policy on selling American-made chips and why it could be a win for your money. Next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
Can you give me a...
What do you want, a rim shot?
Yeah, rim shot.
Yeah.
It all starts at 9 a.m. Eastern.
Philosophy rarely plays a role when it comes to earnings per share. But right now, it's at the fundament of what's going on in the semiconductor space. See, right before the end of President Biden's term, the government drafted a set of very hurried rules meant to keep China from getting our most advanced chips. But in order to ensure that the Chinese couldn't get the latest and greatest, the White House selected 18 friendly countries that could get unlimited amounts of NVIDIA's most advanced chips, ones that Biden thought we could trust. It excluded many others, though, and the omissions, frankly, were pretty shocking. The list itself made me sick to my stomach because the composition made no sense at all. At the same time that Biden suggested these new rules, Jensen Huang, the CEO of NVIDIA, was busy traveling around the world urging that countries have their own sovereign AI so they wouldn't be too dependent on our own culture. Jensen always stressed to me that you didn't want the United States ruling AI. It would only breed resentment. It would restrict it. Sure enough, the Biden proposal worked directly against the sovereign AI proposition that Jensen championed. I was there a day after the rules came down, pretty much the last thing that Biden did, and Jensen was stunned. He'd been playing by the rules all along, and suddenly he was then hit with a list that didn't include countries like, I'd say, Israel or Iceland or Singapore, any of the Gulf states. We sell so much military hardware to these countries, but God forbid they got their hands on some high-end chips. How did that make sense? On the other hand, if you're terrified of the Chinese getting premium chips, well, you might favor these so-called AI diffusion rules. On the other hand, our country's the world leader in this technology, something that's cemented friendships around the globe, distinguishing us as an ally to many nations that might otherwise have sided with the Chinese. It wasn't clear whether the new administration would choose the pure anti-China strategy or embrace the world leadership strategy of previous presidents. This week, we saw Trump's position. He chose world leadership, and he allowed NVIDIA to sell to any Gulf country that wants their product. Trump basically put together a hyperscaler, one that like an Amazon or a Google, and brokered some huge business for NVIDIA. Jensen Huang's now headed to Taiwan to speak at a forum called Computex. And it wouldn't shock me if some of the excluded nations like Singapore put in some very big orders, too. You could argue that I'm just talking my book here. The Chapel Trust has owned NVIDIA for ages, as you know, and its stock has roared as Trump distances himself from Biden's what known as AI diffusion rules. And look, I am talking my book, but I think it's bigger than that. If we want to beat the Chinese, so to speak, we got to befriend and work with the rest of the world. In that sense, if you want an anti-China strategy, it means helping out countries like Saudi Arabia or Singapore using our technology so they stay in our sphere of influence. Biden's AI diffusion rules were incredibly ill-advised and ran counter to years and years of American tech policy. Good to see them buried. NVIDIA is a tremendous ambassador for the United States. It's now unleashed, and it's tremendous for our nation that it can play that terrific role worldwide, rather than just in a bizarre list of 18 already friendly countries, handpicked by who even knows, a forgettable chapter in a suboptimal moment in American history and philosophy. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.